Hi, everybody. This is David Wachsman, and I'm proud to be hosting a live stream right now where we're going to be talking about RWAs. Specifically, the subject of this is the Great Tokenization Shift, how RWAs will, well, this is a question, but potentially reshape finance here in 2025. And I'm joined by some truly esteemed panelists, and I'm going to give each of them an opportunity to introduce themselves. Kevin, why don't we start with you?
Sure. Thank you very much, David. I'm Kevin. I'm the co-founder and CEO of Keyrock. We're a global crypto investment firm, and we're very strong focus on providing liquidity to digital assets, all digital assets, basically, with the main thesis for us, being that eventually all assets will be digital, and that's definitely the topic that we're going to discuss today. How the concept of crypto is going wider than where it started, and actually encompassing more and more real world assets. So very, very much looking forward to this discussion.
I think you're on mute, David. I'm happy to go next if everyone can hear me. So I'm Sid Powell. I'm the CEO and co-founder of Maple Finance. So we are an on-chain asset manager with a credit and lending focus. So we do loans to institutional counterparties. We take cryptocurrency or digital assets as collateral. So think Bitcoin-backed loans, but extending right out to Sol, XRP, other large caps. But our clients are predominantly institutions, and on the other side of that, we offer a yield product to high net worths, hedge funds, family offices, and corporate treasuries. We've been operating for about 4 years, and we've done over 6 billion in loans, and we currently have around 750 million in TVL on the platform. So very happy to be here talking about RWAs.
Great.
So I'll just follow up. I'm Roberto. I'm a co-founder at Backed Finance. We're an issuer of real-world assets, basically tokens representing tradable securities with an emphasis on equities. And our products are fully backed by the underlyings. They are permissionless and they are fully compliant. We're issuing out of Jersey. We have a license to issue the tokens, a valid EU prospectus. We've been selling the products for over 2 years now, and seeing great demand and growth in this sector. Very happy to be here.
Thanks, Roberto. So Kevin, my first question is for you. Recently, Keyrock helped issue a report about the Great Tokenization Shift. Why did you feel like now was the time to do so?
Well, I think the main reason is that, so Keyrock, we started in 2017, already back then, so 7 years ago, we were saying, eventually all assets will be digital. And, I think that's been kind of a recurring song that came back, every year, that accelerated a bit with DeFi summer, then deflated somewhat. And then what we're seeing is that we are now really at a tipping point where, the different necessary pieces of the puzzle. So not only, of course, the technology, the infrastructure, but also the regulatory framework, which allows, greater and greater institutional involvement. But we're seeing that all those different pieces are actually there now, which is really bringing us to a tipping point. And I think the purpose of this report is really to inform, is that this is not about a theoretical shift anymore. It is happening. It is happening with some of the largest institutions in the world. It's happening not only on stable coins, not only on T-bills, but also on private credit, also on equities. We are seeing the shift, and the purpose is to really inform the market about how concrete this shift is, and of course being there to support. It is in our interest as a market maker, as a liquidity provider, as an investment firm, to really see this market grow. We believe that crypto as it is today is just a proof of concept and will eventually encompass all traditional markets. And the purpose of this market is to showcase that we are now at this tipping point, because basically all the different elements are starting to be there.
Well, I think you pretty much just gave a table of contents for what this conversation is going to be about. We're going to be talking about all those different categories, and I think it's very important to do so. But I mean, look, Sid, I've got to say, RWAs, which weren't even a thing, we called them something different. Even when you and I started to get to know each other a few years ago, we didn't use that expression. But there's been people talking about, tokenizing real estate, for example, and other types of real world assets since the beginning. Why didn't it take off? at least initially?
I think there's a couple of key issues as to why, despite this having been a very promising topic for a number of years, we just haven't seen the kind of transaction volume that would have pointed to it being a success. I think the major one that I would have observed is just the lack of buy-side demand. So there is a very strong supply side of people who are willing to issue RWAs to borrow or to just directly to equity style investors. However, when it comes to crypto, most investors and allocators have a shorter time horizon. They do not want to be in a 3 to 5 year transaction on chain, given the opportunity cost of kind of how much upside there is in regular digital assets. And that's why we've seen people have favored shorter term real-world assets, like whether it's receivables finance, which pays off in 30 days, over real estate, which even at the short end is typically a 3 to 5 year type deal. So I think that's probably been the main thing. And then secondary to that has been a bit of a perception from those who allocate or invest on chain that there is adverse selection for these assets. So they are only coming on chain or only approaching on-chain funders because they couldn't secure traditional finance.
So that means they're likely not quite as attractive a counterparty.
Correct. Yeah. So that counterparty risk element and then duration. But I would say duration probably trumps the others.
Roberto, would you agree? In terms of, let me re-ask the question. Would you agree that there's a reason, these are the principal reasons why RWAs had not taken off, at least initially? Because I think we were going to be talking about the Great Shift of 2025.
I think so. I think Sid really has got a point. And at the end of the day, the capital that is attracted to RWAs today is either the usability that is offered by stablecoins attract transactional capital, or a very, very fluid, sometimes called mercenary capital that is looking for very, very short-term yields. And that makes it more difficult to allocate capital to maybe more traditional type of asset classes.
So Kevin, let's talk about some of those traditional asset classes. And why don't we start with stablecoins? Stablecoins right now, you could argue, are more than one asset class. There are different types of stablecoins out there. Can you kind of define what we mean? Because we're seeing, of course, cash-backed stablecoins. We've seen algorithmic stablecoins, but which ones would you bucket as RWAs?
Well, I think definitely the ones that are, asset backed. I would categorize them, as RWAs. I think indeed they are the main example, right, of a category that actually has picked up, and where, as Sid mentioned, in this case, we can actually see the transaction volume that would make it that would allow us to really label it a success, right? And I think that I don't know if your purpose is to go into the reason for that success, but I think that you have, for me, the two main points is that you have a very clear use. There's a very clear reason why a stable coin is inherently superior to a traditional dollar, for example. The speed at which you can transfer, how it can be done 24/7, the cost at which it can be done, like all of this makes it for certain purposes superior than traditional fiat. And so the use case, the utility is very, very clear. At the same time, there is a lack of major regulatory constraint that have basically allowed the second, I think, component that is very important, which is the distribution. We have something that is very easily accessible, to all the different, crypto natives participants that are used to digital assets. So you have something that has a very clear utility, something that has a very wide and efficient distribution. And I think the combination of the two is what really allowed the market to pick up and to make stable coins a 200 billion basically RWA category as it is today. And I think the combination of those two, so the clear utility, why the assets are superior than their traditional counterpart, as opposed to being lower quality asset, as Sid alluded to earlier. So a very clear utility and reason why the assets are superior once they are digital, combined with a wide and efficient distribution, I think is really what is needed for other asset class to pick up as well, basically.
Well, diving a little bit further into stablecoins, we've seen kind of different categories of them. Some that are yield bearing and some that are not. Sometimes they're backed by short-term treasuries and other types of, I'm going to call them cash equivalents. And we've seen some that are they're similar to stablecoins, things like money market funds, for example. Why haven't some of those taken off just yet, Kevin?
Well, I think the main reason here is purely regulatory, right? So I think the moment that you issue a yield-bearing stablecoin, you enter into securities territory, and then who can access it, and then the distribution part of the equation becomes a lot harder, right? And it basically negates the promise of making these assets more accessible to everyone. And I think that has really been the main reason why, out of the 200 billion of stablecoin that you see in circulation today, if you compare that to the money market funds market, I think that's 4 to 5 billions. I think the gap is exactly that, and it's purely regulatory constraints that haven't allowed those issuers to pass the yield on to their holders, basically.
Well, it's funny. Right now, we're being competed with by the nominee for the chairman of the SEC, who is currently in front of the Senate Banking Committee, trying to talk about whether or not he should be, the new chairman of the SEC. And so rules might change, at least in the United States, and perhaps that be reflected elsewhere. Roberto, you certainly have been tracking this as you've been thinking about even tokenizing equities, which I want to talk about a little bit too. Actually, let's dive straight into that. Why should equities be tokenized? What is the upside, the real end user upside of tokenized equities or equity equivalents?
I would say that the first rationale there is that at least the equities we are interested in and that we tokenize have very, very profound liquidity pools in TradFi. So similar to stable coins that basically share the liquidity of, let's say, the dollar, Tesla token would share the liquidity of Tesla, and the price discovery would be almost trivial. And in these type of equities, there are several streams of demand. One is basically accessibility. More than 2/3 of the world resident humans cannot buy these products. We believe there is latent demand there that could be satisfied.
Wonderful. By the way, I just want to interrupt you. Bhaji, I just wanted to say hello. Good to have you on our panel as well.
Fashionably late. Thanks for the patience there, guys. I was listening in the waiting room, though.
Great. Roberto, I didn't mean to cut you off. You were talking about the benefits of tokenized equities.
Yes. And so I've mentioned the demand by users who currently cannot access, I would say, US sophisticated products or even equities. And in addition to that, I think there are extremely sophisticated financial institutions that are interested in managing positions on chain, and this could be another demand for.
What would be the benefit there, Roberto? If you don't mind breaking that down just a little bit. So if I'm a sophisticated financial services firm, maybe a hedge fund or an asset manager, why might I want to use on-chain instruments?
I would say that the ability to do atomic transactions is interesting, and also 24/7. I mean, what happens in the weekend if there's a tweet by Mr. Musk on Saturday? Maybe I can make a profit on the Tesla share.
Yeah.
You've already seen. NASDAQ is introducing, I think, 24/5 trading,
24/5.
which I think is a direct response to crypto. In that, other things equal, if your shop can remain open for more hours, you can do more revenue, and you can it's going to attract more issuers if they think that their stock can trade for a larger number of hours, particularly when other regions are online and the US markets might ordinarily be closed, like Asia, for example. But I was going to say the other element is access. So, I was talking to somebody who's a high net worth the other day, and they were saying that they'd called their banker, and I think this was at JP Morgan, and they wanted to buy Metaplanet stock from the Japanese market. And they'd been the banker came back and said that they couldn't do this. It was actually a lot more complicated than they expected because they take on FX risk, then they have to have a seat at the Nikkei, and so they ultimately couldn't do it for them. What you have as a very sort of crude workaround in the US market is ADRs, or American Depository Receipts, which is effectively like a crude form of tokenization where you buy a bunch of shares from offshore markets, you shove them in a trust, and then you issue shares on the in the trust to US residents. But I think if you could just directly tokenize the asset, it's much more portable, much more liquid, and could actually be purchased by anyone anywhere in the world instead of having very defined geographic boundaries.
I mean, that is, again, with the one caveat that there will still possibly be regulatory restrictions there, conceivably, we'll see. But that's far superior tech, Sid, you were just mentioning. It's just much better access to stocks like, for example, Metaplanet, which is very exciting. It's certainly we've been following over here. Bhaji, what's your take on the benefits of tokenized equities? We're going to get into other asset classes a little bit, but I just wanted your take.
Yeah, and one thing I'll add on to that I think is the kind of interesting two sides of the opportunity that we're talking about. There's the side now, which is that there's new liquidity sources on chain, and a lot of these fund managers that we're working with and the folks tokenizing products, they want to tap into that. And then there's the second part, which is the efficiency and the improvements, the global accessibility, 24/7 trading that can be enabled through the technology. So in the short term, we're looking at tapping into new liquidity sources as a primary driver. In the long term, we're looking at how can blockchain actually improve the system and the process and automate a lot of these structures that have inefficiencies throughout. So I think there's the kind of two worlds where we see an immediate proof point now of driving a lot of the behavior and the activity, but then we're working towards this longer term vision and realization.
Well, I'd say one of those markets that we're talking about here is private credit, something that you certainly have been exploring at Centrifuge. Sid, I want to get your take on this afterwards. But that seems like a market that was pretty damn inaccessible to many investors. Is that one of the reasons why you're pushing so hard to tokenize these types of instruments?
Yeah, so Centrifuge, just a quick background for those who aren't familiar. We were founded in 2017. We started with private credit very early. So started with doing like very difficult to access asset classes. So music royalties, carbon credits, things that traditional investors couldn't access easily in off-chain environments. We then moved, to Sid's point, there was kind of this inverse selection bias in the early days where a lot of those folks and projects who couldn't raise money off-chain would come on-chain. And in the early days, there wasn't great structure and rigor around how to vet and qualify the risk of those assets. We then shifted and evolved to more structured credit. So that's the deal we did with Block Tower and Maker, where it was a $220 million credit facility, $150 million, which was the senior debt from Maker, and then the rest put up from Block Tower. And that was a really good example to the point I made earlier around starting to try to shave off costs and removing intermediaries throughout the process and incrementally improving the middle and back office of how these funds are run. Ultimately, the Block Tower fund closed after 2 years, returned capital to investors at a 24% return, saved 97% in the securitization process as they reflected. And
so what is that? Can you give us some numbers about what that means? 97%. That's a great number, but how much money are we talking about here?
Yeah, so the total cost for them of running the fund for 2 years on chain was $40,000 all in, with all the reporting built out. So they compared $40,000 to what it would have cost in the traditional process of running it off chain. And that's how they got to the 97% cost reduction. So that's
an investment bank would look at 40,000 and say, that's probably just how much we're paying our staff for working overtime and giving them dinner.
Yeah. So, and there's other benefits too, like the more macro side of it, which is that all the underlying assets are tokenized at the individual level. So there's full visibility into how that CLO and how that securitization is structured. The smart contracts handle the payment distribution, the equity buffers, the fees, the rules enforcement. So they were able to prove out a lot of that vision of what it looks like to run a fund on chain. Ultimately, Centrifuge, over the years, we've evolved to focus more on the public credit side and started doing a treasuries fund and moving into fixed income over the past year or two, just because that's where we were seeing investor demand. So to come back to your question, David, we really built out these private credit deals and we built the platform in a way that supports that type of structure, but we just weren't seeing the buy side demand for those types of deals yet, largely in part to duration and to how quickly things move on chain and the investor interest of looking at those risk adjusted returns. But ultimately, we do believe that's a direction that the market will move in, and we want to support that when the time is right.
Kevin, where are we seeing that buy side demand right now?
Maybe just before addressing that one, I think we all mentioned accessibility, right, as kind of one of the main advantages for tokenizing these assets and equities, for example. I think that what I would like to add to that is, even if you can today have access to these assets, they live in a silo, basically. Even maybe a bit less so for institutionals, but very much so for retail participants. If I buy a share, that share is mine, but it exists in a very defined silo. I think that what makes tokenizing assets very exciting is that these assets all of a sudden have a digital existence outside of any silo, and they just belong to you and you can use them however you see fit. So I think that, if I take an example, I own some shares and I want to use them as collateral for a Lombard loan with a certain bank, but the bank that provides me the loan is not the same that the one I've used to buy these assets. All of this is a nightmare for no reason whatsoever. I mean, I have two different counterparties, assets that are mine. I want to use them for something. It's an absolute nightmare to do in the current setup, and that's even being in Western countries where usually access to capital markets is a lot easier. I mean, I live in Switzerland. If I would like to do that, it would take me weeks of admin and potentially, come, of course, with major costs. Now, the moment there's the example of shares there, they exist as tokens. I can just put them on as collateral on any worldwide global lending markets without having to ask anybody for it. And I think that there's this notion of accessibility, yes, of course, but I think even more so than that, you have the widening of the market that you can access with assets that you can control yourself directly by taking them outside of just a silo. And I think that this is what makes the whole thing so exciting. Now, to get back to your initial question on where we're seeing the demand currently, I mean, that of course is going to be very, very dependent to each asset class, right? I'm sure that the growth that Roberto is seeing, on tokenized equity is going to be very different than what Bhaji or Sid are thinking more on the credit or the tokenized money market funds asset class, right? I think that where we've seen the biggest growth, I mean, clearly, and that's why we see the biggest side of the market today. I think that one on stablecoin, I think there we're seeing it from everywhere. Quite simply, what is interesting is that in the past on stablecoins, like we are market makers and wholesaler for basically most large stablecoin issuers. It used to be very crypto native, right? It used to be a lot of users linked.
Yeah,
like basically people that were transacting on stablecoins with us were always for users linked to the crypto market itself. Is how I'm using this to trade something else. It was really very much linked to the crypto market. What we've seen over the last year that is quite interesting is that more and more of our clients on the OTC side are actually corporates using stablecoin just as a mean of international payment. Nothing to do with crypto anymore. I mean, where Bitcoin is good, exactly.
Really this is really interesting. You're telling me that you're seeing real corporates, Web 2 or Web 1 type companies that are using
web.
it.
We're talking industrial companies, like nothing to do with even the web. No, I'm serious. And this is something that is, of course, a very interesting growth segment for us, because it has nothing to do with what Bitcoin is doing. It's just like, I have an asset here that serves the same purpose as the traditional one I'm used to transact with, but the difference is that now I can transact on it 24/7 in seconds at almost no cost. This is way better. Let's use that. And so this is, of course, a drastic change in the usage of stablecoin. I think that seeing that now at the corporate level, plus of course all the different uses that can be, for global payments at the retail level as well, is what pushes most people to believe that 2025 is really going to be a transformational year for stables. And the reason why Stripe, I imagine, acquired Bridge and so on and so forth, we're seeing really that pure use of the asset for its utility and not for its linked to crypto speculation, basically.
Roberto, forgive me. Roberto, I wanted to ask you. Right now we're seeing about a $200 billion or so. This is a rough estimate. Stablecoin market. What do you think is possible in 2025? Do you think it grows? Do you think we stay flat?
For stablecoins?
Yes, for stablecoins.
I would say that roughly, I wouldn't say that I expect a growth of an order of magnitude. I would say that we can see more moderate growth than we saw in recent years, but still, I do expect this to grow. Private credit is probably going to grow very, very rapidly. And hopefully equities will reach at least the 1 billion mark this year.
Bhaji, you were
Yeah. So two things. On the growth side, I think what's interesting to look at is if you look at year-over-year growth of stablecoins, last year it was about 60%. And for tokenized treasuries, it was about 400%. So we're seeing increased growth rates on the tokenized treasuries side, largely in part because there's some conflation between the two, where the kind of yield-bearing stablecoin versus non-yield-bearing stablecoin and how we categorize those. JP Morgan just released a report this morning where they forecast that we'll go from 60 to 50% market share for yield-bearing stablecoins. So I think what we're seeing, and this goes back to one of your earlier questions around what's different now and why we're seeing this growth in the RWA space, is there's such integration between the two. So a lot of the growth of yield of traditional stablecoins also fuels the growth of money market funds and yield-bearing stablecoins, because a lot of those are backing the traditional stablecoins. So as, for instance, we saw Usual grow, that also related to growth in Hashnote because that was the underlying RWA that was generating the yield for that stablecoin. So there's really tight integration and also very strong correlated growth that we'll see from the stablecoin side, as well as the tokenized treasury and money market fund side.
Well, I mean, I think we have to say that other circumstances have changed too. It's a lower interest rate environment now, and presumably it's going to be dropping by another, 50 basis points or so over the rest of 25, according to the Fed. Theoretically, that would be a little bit less attractive than it was in the very high interest rate environment of last year. Sid, thoughts?
Yeah, I mean, the other thing that came up during 2023 was that there was, Operation Choke Point 2.0 was kind of pretty active. So most crypto firms could not access regular forms of money market or indeed just corporate general transactional banking services. So I think that spurred tremendous growth in the tokenized money market sector. I would expect, to Roberto's early point, I think you continue to see pretty robust growth in the stablecoin side, not the least of which is going to be driven by just new issuers entering, right? So you've now got Ripple with RLUSD, so they're going to want to grow the market cap of that. And then you have the two biggest players, Circle and Tether, also trying to grow, particularly Circle, given that they're gearing up for an IPO. But that has positive downstream effects for everyone else in the crypto economy, because more stablecoin inflows naturally lead to more purchasing of other assets, I think. But as to the split between tokenized money markets, I think, as you pointed out, David, if you do see rates come down, they become slightly less attractive. And also, if rates came down, the secondary effect would be that people are going to flip into risk-on assets. So you're not going to be holding a money market fund for long if you think that Bitcoin or Solana or other large caps are going to appreciate 40%. That's what we saw in November, December, is that everybody went risk on the expectation of lower rates coming. And I think if you see a rate cut for the rest of this, if you expect rate cuts for the rest of this year, you'll start to position yourself to capture price appreciation on the other assets. But that will also drive more stablecoin circulating supply.
Kevin, what do you think happens if we see either, I guess call it the expected lowering of interest rates right now, about 50 basis points? Do you think we're going to see, as Sid was saying, flows into like really risky assets? Do you see something in between, maybe some of these tokenized commodities?
I mean, so tokenized commodities, I don't know. I think that's a bit of a trickier one, also given how like the very structure of the market, itself on the traditional side of things, and how everything in crypto is more retail driven. So there's a bit more of a mismatch there for tokenized commodities. On the first question, I mean, definitely, I do think that having lower rates is going to have a positive impact, on riskier assets in general. So definitely on crypto and digital assets. I think that despite that, I think the growth there is going to be so large that it will indeed also create a growth in stable coins and potentially money market funds, despite the rates being a bit less attractive. I think it's going to potentially be because the rates are less attractive, a lower market share of the crypto participants. But I think that the crypto and digital asset participants are going to grow by so much that the end effect will still be growth in both of those categories. Now, I think that commodities, I do think the challenges there are a bit different than for the other assets, as I mentioned. I think that the very structure of the market is a lot more institutional driven than what we would see, for example, potentially on equities. And I think that's also part of why tokenized commodities have not picked up as much as some of the others. But so I don't think that the reasons are directly linked to where your rates are going to be going, basically.
But I think like tokenized commodities, you can't speculate and hit 100x on that necessarily. Whereas if rates come down and everybody piles into growth assets, they want to trade the things that trade like proxy tech stocks, which are going to be altcoins, DeFi tokens, other on-chain assets that resemble or that have historically traded like growth assets. Whereas commodities, I just don't see the average retail investor piling in to try and hit 100x, but I can see them piling into like a meme coin or a DeFi coin for that.
Roberto, or maybe they're thinking about small cap stocks, tokenized. What do you think?
We did tokenize some small cap stocks. Demand was not as strong, and I think that price discovery and liquidity are key. So I would say that the larger cap stocks are probably the primary candidates for growth.
Well,
just think of composability, having an S&P 500 token on Aave, which is actually a proposal that is out there at the moment. This is something that many users might find useful if they believe that this is an asset they would like to bet on.
Roberto, when you tokenize a penny stock, is the price driven by what it is? Is it just an oracle of what's happening off chain, or is the price actually being driven by how it trades on, in a tokenized market like a DEX or something?
For large,
are you asking Sid
for small caps, penny stocks?
Yeah,
that's a good question. It's very, very hard for us to. I mean, we typically issue large cap stocks. Okay. Tesla, Google, Microsoft, even Coinbase has much more liquidity off chain than it does on chain.
Well, actually, hold on. I have a follow-up then, a related follow-up. We've seen also, and this is kind of some of the OG days of the major crypto investors were investing in private share companies. So Second Market, for example, was one of the original companies that eventually became DCG in some ways, Digital Currency Group, because people saw parallels between those things. Do we see the tokenized private shares could take off? Because, of course, previously they've had very limited liquidity. Roberto, I'm asking you first, and then would love anyone else's take.
There's a beautiful project in Switzerland called Actionariat that actually does that in Switzerland. The DLT Act allowed this to be feasible for several years now. And they've been struggling to attract liquidity to basically have users buy those tokens that represent shares, but they do not tokenize the shares. The shares are the tokens. And that has been challenging for that project. Would that replace one day the investment banks and the large exchanges that we know of? Maybe, but I think this is still
You mean from
a way to go.
public to begin with? Instead, it could be, they may not necessarily have to, you're saying.
Yeah, I think it's a lot to do with the interests of very, very large financial institutions that drive liquidity. Liquidity is the name of the game here.
I was going to say, it sounds like private equity might be interested, but Bhaji, maybe you have a take?
I think a lot of really smart people are focused on it. We saw Vlad from Robinhood is putting out a lot of content around tokenizing private equity and starting to bring more products into the Robinhood ecosystem. So there's definitely opportunity and interest, but it will just come down to the demand and how we're connecting, how folks are able to tap into existing networks to match that supply and demand.
And perhaps a little bit about regulation. And Kevin, I do want to shout out that Keyrock recently opened up a branch in the United States. What's your take? First, why'd you do that? And what's your take on the changes in regulation here in the United States in 2025?
So why? I mean, just because it's the biggest capital market in the world, and that's clearly the mindset around digital assets and crypto dramatically changed in the last few months, and so for us it was just an impossibility not to be there. We're seeing I think for the last 3 or 4 years the tune was always okay. The US is kind of off limit now, but eventually this market will come back, and I think eventually it's going to be the biggest digital asset market, the same way that it is in TradFi. And so for us, of course, we had to be there. I think that my take on the regulation there, I mean, as you say, there are some folks currently discussing in Washington, so maybe my take is going to be outdated in the next couple of hours. But I think that the framework has not really changed so far. I mean, there's still a lot of uncertainty. The thing that did change, however, is the mindset, is the fact that this kind of a constant threat of regulation by enforcement. This is somewhat gone. And so now you know that you can actually, in confidence, go and start and develop your activity, as long as of course, you do it with a lot of goodwill and always keeping track of where the actual regulation is. You're not putting yourself at risk as you would have, if you were to open in September. And so I think what has changed so far is only the mindset, but that is a big enough of a change for us to decide to open the entity, and then hopefully in the next weeks, and month. And I think that starting with stablecoin, the actual framework itself is going to become much more clear, and this will continue to drive additional institutional participation in the market itself.
Yeah, there's
which
a
we want to be a part of.
stablecoin Congress right now, which is certainly getting a lot of attention from both sides of the aisle. I do want to ask, Roberto, perhaps you've got a strong take on this. What does its potential passage mean for other jurisdictions, places like Europe? It's very important, although I might be an American. This is a global market we're talking about here. And the US might be the biggest capital market in the world, but it's not the only one. So what does this mean for other jurisdictions?
So we saw MiCA, and that attracted a lot of attention. I think as soon as the US shows more clarity from a regulatory point of view, and the reduction in perceived risk that Kevin just mentioned is already proving to expand the US market significantly. I think very, very rapidly we could see a very dominant US market in crypto, in tokenized assets, in all its forms. And at the end of the day, other jurisdictions will probably, most of them will follow. I don't know if Europe will follow, but I think that many Asian jurisdictions will follow. I don't know about China, but
we'll follow in
possibly India, Japan.
You're saying follow the U.S. course, regulatory course.
At the end of the day, the U.S. does have a potential to be a leader there. I think it should be a leader in creating the right environment for tokenization and for crypto to be accessible to everyone. And hopefully it will be the reality in the next few years.
Bhaji, what do you think?
Yeah, I think we're the stablecoin bill in a lot of ways is similar to MiCA. So there's precedent that we can adopt from what other jurisdictions have done. There's also been some good progress already in Singapore and Hong Kong with ADGM and with VARA. And there's a lot of positive regulatory structure that's been created that can be looked to as a guide. But ultimately, to Kevin's point, there has been just a fear of innovation because of ruling by enforcement and not creating clear guidelines. So that will set a precedent for bringing more innovation, bringing more development back to the US. From the Centrifuge perspective, the work we are doing, like there are pretty specific and clear guidelines and regulations around securities, and all of the tokenized products we bring to market are security tokens. So we've followed within those guidelines, but there's just been this hesitation from large banks, large asset managers, the more traditional institutions to move without having more general positive sentiment for the industry. So BlackRock entering this space and going all in on it, and a lot of these other asset managers, and now the positive regulatory tailwinds, it just changes the sentiment and the energy and the urgency to start to build and to start to move in the right direction.
So if I might paraphrase this, and please tell me if I'm kind of accurate, even though you've been working in the security token space with real securities, because of the sentiment around the technology that you're using for securitization, that alone was perhaps preventing its ultimate success.
It had in the past, and that's changed recently. There's just there had previously been a general hesitation for large institutions to put their name on any of these crypto projects for the reputational risk, for the regulatory risk, for the uncertainty around how the industry will move. And that is changing. So that's unlocking the floodgates of, okay, now there's enough energy here, there's enough legitimacy here, there's enough infrastructure and technology here that we all need to move quickly, otherwise we'll fall behind.
Sid, would you agree? Is energy here for us to be bullish?
Yeah, I think there's a reason I'm here in the US as well, and not back in Australia, which is that this is kind of the best market to to build a crypto startup in. And I think to Bhaji's point, you had like what the FDIC was doing was basically illegal. They were telling banks and other financial institutions not to even touch crypto clients, which was extrajudicial and totally outside the bounds of the law. So I think like legal clarity, the stablecoin bill, the market structure bill will be great. But the most important thing they did was just kind of drop the stick and stop threatening crypto companies. And I think that's easily conveyed in guidance and the rhetoric that's coming out from the administration. I think that the danger for the US is that it kind of goes the rules that it puts in place are probably too strict. We've already seen that with Europe. I think probably Europe overstepped with MiCA. We looked at kind of setting up a VASP in one of the jurisdictions there, and we were guided that it could cost you 150k euros and take 9 to 12 months to do something through Luxembourg. So you're going to go jurisdiction shopping in Europe, but we've already seen that Europe has declined Tether, and the other day declined Athena, so that they're already pushing innovation out. And so I don't know that more clarity has helped if that clarity is indeed bad for the realities of running a commercial operation. So I think, I'm very positive on the US side, but I hope that they just don't go too far in putting in place rigid, inflexible regulation.
Kevin, what are you most bullish about for 2025 when it comes with RWAs? When it comes to RWAs?
Most bullish about, in general, is their growth. I would say, I think that interestingly, is for us as a market making company, right? The question was always, when do we actually start being very active? We're active on secondary markets, right? So we're not in the issuing business, and we're not in the historically we were not in the asset management business. So it was okay, when do we start to be active on secondary market? If you write too early, you end up being wrong, right? Because if we had everything set up 7 years ago, saying all assets would be digital, let's get ready, we basically would have sat on whatever we would have put in place for the last 7 years. I think that what I'm excited about is the market being a place where it does make sense for us, who historically have been focused on the crypto market, to also be really actively involved on RWAs, because now, outside of stablecoins, other types of assets, the size and the momentum justifies it. And so I think in general, what I'm excited about is just the realization of, basically the last 7 years of preaching. I think that we're getting there now. I think that what we see with tokenized treasuries, credit markets, equities, I think all those markets are going to grow tremendously in 25. And I'm excited to see the first secondary marketplace being really open and actively traded on. That's really definitely something I'm excited about.
Well, I'm excited to watch all of you CEOs here keep hiring out of traditional Wall Street and other centers of finance all around the world. I think it seems to me, I'm going to call myself an audience member here, that the worlds are blending, and the organizations you've created are evidence of that. So thank you, panelists, for this invigorating discussion. It's been wonderful hearing about the growth of RWAs. I'm bullish on it, and I can't wait to see what you guys do next.
Thanks
Thank you very much.
Thank you very much.
Thanks, everyone.